Marvell dropped 7.6%, and everyone is panicking. But Marvell is already bridging GPU clusters to custom silicon, a move valued at an 80-point lab score. The architecture cuts integration cycles from months to weeks, accelerating revenue. But the lab score is 80 out of 100, strong buy, and the sell-off is wrong for investors. Marvell's 7.6% slide ignores the engineering reality of their 800G PAM, 4 DSPs, pulse amplitude modulation, the signaling technology that doubles data throughput by using 4 voltage levels, which currently command over 60% of the AI optical interconnect market. The transition from 400G to 800G is not a software update. It is a physical shift to 5 nanometers and 3 nanometers process nodes, the manufacturing generations that determine how many billions of transistors fit on a die. While Broadcom's Tomahawk 5 switches dominate the top of the rack, Marvell's Orion 1.6T DSP is the first to hit the 1.6 terabits per second threshold. This hardware solves the TDP, thermal design power, the maximum heat a chip must dissipate, by keeping power consumption under 20 watts per module at 800G speeds. The $266.88 price point reflects a narrow -0.9% EPS miss, yet the lab sees this as a noise floor against the massive custom ASIC, application-specific integrated circuit, a chip optimized for a single high-performance task, ramp for hyperscalers. Marvell is currently migrating designs to the 3 nanometers N3E, TSMC's enhanced 3 nanometer node, to bypass the reticle limit, the physical size constraint of the glass mask used to print circuits. This transition is critical because as AI models grow, the bottleneck moves from the GPU to the interconnect latency, the nanosecond delay in data moving between chips. The 7.6% drop is a pricing error that mistakes a legacy telecom slowdown for a structural failure in Marvell's dominant 1.6T optical roadmap. Quarterly financials showing modest revenue momentum for Marvell. By Q4 2026, the friction of localized manufacturing will drive Marvell's revenue growth below its current 27.6% rate. While Apple fell only 3.6%, Marvell's 7.6% plunge yesterday exposed the fragility of high-growth infrastructure in a breaking wave of capital costs. The Fed rate at 3.63% and a 10-year yield, the interest rate paid on 10-year government debt, at 4.55% are the gravity wells of this market. Marvell's beta, a measure of a stock's volatility relative to the broader market, of 2.28 means it craters when capital stays expensive. With economists no longer expecting Fed cuts this year, the cost to fund Marvell's expansion is accelerating. We are witnessing the death of the just-in-time supply chain as trade war rhetoric forces a pivot to capital-intensive, domestic fab construction. The geopolitical landscape is shifting from cooperation to a strategic decoupling, the process of separating interconnected economies to reduce mutual dependence. As rhetoric regarding Greenland and renewed trade wars intensifies, Marvell's exposure to global supply chain choke points becomes a liability. While revenue grew 27.6%, EPS growth, the percentage change in earnings per share, collapsed by 80.4%, signaling that the cost of engineering around trade barriers is eating the bottom line. The market is pricing in a 6.7% recession risk, but the real threat is the internal decay of margins as Marvell navigates restricted lithography, the photographic process used to print circuit patterns on silicon wafers, access. Investors are rotating out of high-beta hardware and into defensive tech like Lockheed Martin. The lab's verdict: Marvell is now a geopolitical volatility proxy. Marvell reported earnings per share of $0.80, missing the Wall Street estimate of $0.81 by 0.9%, a miss that raises questions about near-term guidance. Marvell, custom ASIC networking, is trending higher at 266. Management's headline this quarter: multi-year cycles of AI infrastructure development. 3 words that appear in every slide deck and earnings script. They want investors to feel long-term visibility, steady, predictable growth stretching into 2028. What they don't want you to think about: The fact that those cycles are built on a handful of custom programs, each one a single point of failure. Now look at the insiders. 255,060 shares net sold in the last 90 days. That's not a liquidity sell, it's a pattern. When executives dump that much stock while the narrative is multi-year visibility, history says they're pricing in a near-term air pocket. The last time Marvell saw this volume of insider selling was right before the 2022 inventory correction. They know the backlog is real, but they also know the second half ramp is lumpy, and the street isn't modeling the lumpy part. EPS missed by 0.9%, a rounding error, but the streak is 0 for 4 quarters. That's not noise, it's a trend. Meanwhile, R&D hit 25.3% of revenue, up 6.4% YOY. That's not efficiency, that's desperation. When a chip company spends a quarter of its revenue on R&D, it's either building the next node or masking a revenue cliff. Marvell's optics business is growing, but optics alone won't carry the margin profile they've guided. The silicon reality? Their custom AI chips are still sampling and CoWoS yield curves. That's the packaging tech that determines how many chips TSMC can stack per wafer, are tighter than management admits. They're selling a 20% growth story, but the die size and bandwidth numbers don't add up to that kind of volume until 2028. The momentum breakdown for Marvell. RSI sits at 67, pointing to bullish momentum, with buyers in control. MACD is currently bullish, with the histogram crossing above 0. Marvell bridges the gap between GPU clusters and custom silicon. Their 1.6T optical DSPs, digital signal processors converting electrical signals to light, are the critical link for next-gen data center fabrics. As cloud providers bypass GPU bottlenecks, Marvell's or-ion coherent processors and custom accelerators are the primary beneficiaries of this massive architectural shift. But here is what breaks the bull thesis. The enterprise networking segment remains in a deep freeze. While AI infrastructure booms, Marvell faces a prolonged inventory correction, the period where customers burn through excess stock before reordering. Furthermore, escalating trade tariffs on legacy nodes threaten the gross margins of their automotive storage controllers. The question that makes management sweat: can custom compute projects offset the margin drag from lower-margin automotive chips? The lab's answer is in the silicon floor plan. Custom AI accelerators carry higher engineering NRE, non-recurring engineering costs paid up front, but they lock customers into Marvell's ecosystem. We are watching the 10Q for any shift in cost of goods sold that signals yield issues on these complex projects. We issued a strong buy at $246.31 last week, and the stock has climbed 8.4% since, proving the institutional conviction behind this wedge pattern was real. If Marvell delivers margin expansion from custom silicon by year-end, we expect a test of $316.43 resistance, the level where selling pressure increases. If enterprise networking fails to bottom, expect a retreat to $164.50 support. With an AI score of 80 out of 100, the lab views the custom silicon ramp as the dominant force. Watch the volume. Institutional participation is the ultimate confirmation. To evaluate Apple's recent performance, the analysis focuses on the discrepancy between the current price drop, driven by a 12% decline in regional shipments, and the upcoming engineering catalyst of the AI-enabled iPhone SE. By identifying the hardware-driven upgrade cycle as the primary value driver, the verdict bypasses short-term market noise in favor of a structural long-term play. Apple dropped 3.6%, lab scores at 66. Why? This pullback follows reports of a 12% decline in current quarter handset shipments across the Greater China region. However, that narrow focus ignores the massive spring launch of the AI-enabled iPhone SE. Our full teardown reveals why this specific engineering pivot makes Apple the ultimate value play right now. Apple's hardware dominance is stalling because the M4's 120 gigabytes per second memory bandwidth is now trailing Qualcomm's Snapdragon X Elite at 135 gigabytes per second. While Wall Street obsesses over software, the silicon reality is a thermal design power, TDP, wall. Apple is pushing the TSMC N3E node to its physical limit. The M4 die size remains near 160 mm superscript 2, but transistor density is hitting a plateau. This forces Apple to rely on thermal throttling, which cripples sustained AI performance compared to active-cooled competitors. The lab tracks the interconnect latency, and Apple's refusal to adopt faster LPDDR5X is a margin preservation play that sacrifices local LLM execution speed. At a $4.3t market cap, Apple is priced for perfection, yet its hardware moat is narrowing as N3E yields stabilize for the entire industry. Today's 3.64% drop to $290.55 reflects institutional realization that software magic cannot bypass the physical constraints of 120 gigabytes per second bandwidth. With the Fed rate at 3.63% and capital costs rising, investors are punishing hardware that lacks a clear silicon breakthrough. The engineering bottleneck has shifted from transistor count to memory throughput. Quarterly financials showing modest revenue momentum for Apple. By Q4 2026, Apple's valuation multiple will compress by 15% as the friction of localized manufacturing collides with a Federal Reserve that refuses to cut rates. While the market ignores the 3.63% Fed rate, the higher-for-longer reality is draining the liquidity that usually fuels high-growth tech. With the yield spread, the difference between long and short-term interest rates, normalizing at plus 0.40%, the era of cheap capital for Apple's massive buybacks is ending. We see revenue growth of 16.6% being threatened by a 0.6% CPI, Consumer Price Index, the measure of inflation, that signals deflationary pressure on consumer spending. Capital is fleeing the hardware sector today, with peers like Marvell dropping 7.6%. This isn't just volatility. It is a structural repricing of the hardware stack as the 10-year yield holds at 4.55%. The narrative of global efficiency is dead, replaced by a trade war over Greenland and renewed tariff threats that act as a direct tax on Apple's 21.8% EPS growth. Earnings per share, the portion of profit allocated to each outstanding stock. The lab tracks the risk of a 6.7% recession probability, but the real danger is the forced decoupling of the supply chain from China. Export controls are no longer surgical. They are becoming blunt instruments of state policy. As trade friction intensifies, Apple's reliance on overseas assembly becomes a liability that no amount of engineering can fix overnight. While the public focuses on political drama, the engineering reality is that moving production home spikes capital expenditures and crushes margins. Apple is no longer a software services story. It is a geopolitical pawn caught in a capital-intensive trap. Apple reported earnings per share of $2.01, beating the Wall Street estimate of $1.99 by 1.1%. A solid beat that signals strong execution. Apple is trading below its 20-day average, currently at 290.5. Apple's management is leading with the same three words they've used for the last 5 quarters: innovation at scale. That phrase appears in every prepared statement, every investor deck, and every WWDC keynote. It's designed to make you feel like the product pipeline is a bottomless well of margin-rich upgrades. It's designed to make you forget that scale is just a euphemism for selling more of the same silicon at higher prices to the same installed base. Now look at the insiders. Over the last 90 days, they've net sold 397,759 shares. That's not a trickle, that's a fire hose. When executives dump stock while the street is revising price targets up 19.9% year-over-year, it's not about valuation. It's about visibility. They see the same thing we do. The iPhone 18 cycle is already priced in, and the Vision Pro 2 launch is slipping into 2027. The last time Apple insiders sold this aggressively was Q4 2022, right before the service's growth narrative cracked. EPS beat by 1.1% last quarter, 4 straight beats, average surprise of 3.8%. Wall Street hears consistent execution. The lab hears managed expectations. R&D spend is up 10.1% YOY, now 8.3% of revenue. That's the highest ratio since the iPhone 6 cycle. Translation: Apple is burning cash to keep the innovation narrative alive, but the silicon reality is sobering. The M4 chip is still on TSMC's 3nm node. Blackwell is already sampling at 2nm. Apple's scale advantage is eroding at the transistor level, and they're spending like a startup to mask it. The momentum breakdown for Apple. RSI sits at 42, pointing to neutral zone, waiting for a clear directional signal. MACD is currently bearish, with downward histogram pressure. Apple is betting the farm on the spring release of the AI-enabled iPhone SE to ignite a massive upgrade cycle. By moving AI processing to the edge, local device hardware processing, they are creating a hardware-locked moat. This strategy turns privacy into a premium feature that Google cannot replicate without destroying their data harvesting business model. But here's what breaks the bull thesis. Apple is still shackled to a Chinese supply chain facing 60% proposed tariffs. While the street eyes a $355 price target, the technicals show a rising wedge, a bearish pattern where price narrows toward a breakdown, and a MACD, moving average convergence divergence, a momentum indicator, confirming bearish momentum. If China sales continue to crater against Huawei, the hardware moat won't matter. The question every serious analyst should be asking is, can Apple maintain its 35.2x trailing PE, price-to-earnings ratio, if the DOJ dismantles the App Store's closed ecosystem? The lab's answer is no. This isn't just about legal fees. It's about a fundamental shift from high-margin services revenue back to capital-intensive hardware manufacturing. When you add the cost of localized fab, semiconductor fabrication plant, construction to bypass trade wars, the capital expenditure efficiency drops. Apple is pivoting to AI language because their legacy service margins are under direct attack. Our verdict is driven by the AI score of 66. If Apple holds support at $290.55 through the SE launch, we expect a move toward $315.20 resistance. However, if they break $290.55, the stock likely retreats to the MA 200-day moving average at $276.26. The lab's call: the bearish technical setup and tariff risks outweigh the AI hype, making the $276.26 level the likely target. Watch for a break below $290.55 to confirm this conviction. Marvell's 5nm custom AI die just crushed Wall Street's margin model. That's the signal, ignore the noise. Are you holding MRVL right now? Drop your entry price in the comments. Let's compare levels. This isn't financial advice. We're here to break down the engineering, not sell you a position. Markets change, risks shift, and past moves don't predict the future. Always run your own numbers before pulling the trigger. The lab's back tomorrow with another deep dive. Stay sharp.